That gold and silver prices are going to keep going up.
The CME halts the bench market for 90 minutes here, cancels day orders and same-day GDDs, then reopens right after the first notice day. I mean,
the institutional investors who aren't really buying physical gold for delivery, they're buying the ETFs. Maybe they're going to buy the gold mining stocks. I think a lot more institutional money, whether it's hedge funds, pension funds, endowments, is really going to find its way into the precious metal space.
New major news out of India. The CBEBI has updated their rules, giving India's $385 billion actively managed equity funds a lot more flexibility, allowing up to 35% to go into gold and silver instruments. They're also shifting valuation towards domestic spot pricing starting on the 1st. I mean, if even a fraction of that capital pool rotates into metals, what does that do to the global physical market? And how important is that India is moving valuation away from the London-based price conventions?
The Indians and the Chinese, they were buying. They were buying more than we were selling. A lot of these gold stocks are hitting new 52-week highs today. The gold was above 5,500. It's now below 5,200.
Let's jump into that chaos from yesterday, because I know maybe you watched this. I mean, the CME halts the bench market for 90 minutes here, cancels day orders and same-day GDDs, then reopens right after the first notice day. I mean, without speculating, I guess mechanically, what changes when the benchmark market goes dark like that? I mean, are we, talking about wider spreads, thinner liquidity?
Well, obviously that would be the case to a limited degree, because if certain markets are closed, that does limit liquidity, but other markets are available. I know, just retail at Schiff Gold, we didn't stop selling gold, right? So it didn't impact what we were doing. But obviously it has some impacts. The question is, why is this happening? Is it just, a coincidence? Well, because maybe there's more volume now and that's putting more pressure on the exchanges? Or, is there something going on that we don't know about? And is this, something that's deliberate, meant to diffuse some other problem that we don't know about? And they come up with an excuse that is, better than telling the truth. I have no idea.
Yeah.
But the one thing I know is that gold and silver prices are going to keep going up.
Yeah.
And so even if there's something going on to try to slow it down, it's not going to stop it. I think that the trend is ongoing. It is deeply ingrained. It is early. Even though gold prices have been rising for 25 years, right?
When a benchmark market suddenly goes dark for 90 minutes, that's not routine plumbing. That's a stress signal. As Peter Schiff points out here, liquidity doesn't vanish entirely, but price discovery absolutely thins out when the CME halts trading and cancels day orders. Wider spreads and fragmented flows matter most during first notice periods, especially with gold up more than 20% year over year. The quiet question is whether this is operational strain or volatility containment. Retail keeps trading, but institutional hedging pauses. That asymmetry is rarely discussed. Next, Peter Schiff discusses why he believes the long-term uptrend overrides these disruptions.
Go back to when I first started buying gold for my clients and recommending gold and buying it for myself. Gold was under 300 and silver was under $5. So from that respect, it's not the beginning of the bull market. It's been going on for 25 years. But I think what's early is central banks buying gold, which really just started a couple of years ago. And I think this trend is only going to grow. I think the central banks that have been buying gold are going to buy more. I think the central banks that haven't bought gold are going to start. And I think what's even newer is the trend for private investors, mainstream investors, that for the last couple of decades have had no exposure to gold, despite the fact that it's gone up so much, are now just starting to introduce an allocation to their portfolio for the first time. And so you've got investors looking at gold and silver. You got central banks. Prices can only go one way, and that's up.
Yeah, well said. And when you say Main Street's back in, I mean, you sell gold. I mean, where exactly are you seeing it show up? Is it coin and bar premiums? Is it that dealer backlog ETFs? And if you had to pick one hard indicator that separated, Main Street from institutions, what is it?
Well, we're still not as busy at Schiff Gold as we were in 2020.
A 25-year bull market doesn't mean the easy money phase is over. it may mean participation was missing. As Peter Schiff points out here, gold's move from under $300 to above $5,000 reflects structural currency debasement, but central bank accumulation only accelerated meaningfully after 2022 reserve shocks. That shift matters more than retail coin sales. Yet he admits dealer activity is still below 2020 panic levels, suggesting Main Street hasn't fully re-entered. The real inflection will show up in ETF inflows and portfolio allocations, not anecdotes. Next, Peter Schiff discusses whether retail demand is truly building beneath the surface.
That was our busiest year during COVID. People really started to worry and they were buying more gold and silver than they're buying now. But business has picked up in the last couple of months from what was very slow. And that isn't unique to Schiff Gold. I mean, I talked to the wholesalers, I talked to other dealers, and, business has been, nothing to, really write home about. I mean, yes, we sell every month, people buy, but it's still small compared to the overall investing public. I think that's going to change. I think a lot of people that had no interest in gold and silver are going to develop an interest. I think a lot of the people who got distracted by Bitcoin as the air comes out of that bubble, and I think there's a lot of air that's yet to come out, and I think we're going to see that soon. I think a lot of that money, most of that money is just going to go to money heaven, but I think the people who lost that money in Bitcoin, to the extent that they have more money to invest, will now consider gold because they won't, throw any more money away on Bitcoin, but they'll recognize that there is real potential in owning actual gold. And so I think that's going to happen. And I think that's going to happen too, on Wall Street as well.
The loudest rallies often happen before the public fully shows up. As Peter Schiff points out here, dealer volumes remain modest compared to 2020, meaning this isn't panic buying, it's early repositioning. That's important because broad retail participation usually marks mid to late cycle behavior, not the beginning. His argument that crypto capital could rotate into gold assumes risk appetite contracts sharply, especially if speculative assets unwind 30 to 50% like prior cycles. But investors should remember, displaced capital doesn't automatically flow into metals. Next, Peter Schiff discusses how Wall Street institutions may respond differently than retail.
The institutional investors who aren't really buying physical gold for delivery, they're buying the ETFs. Maybe they're going to buy the gold mining stocks. I think a lot more institutional money, whether it's hedge funds, pension funds, endowments, is really going to find its way into the precious metal space.
Yeah, that's interesting. I mean, there are people talking about this on the ETF side. Jane Street's 13F shows that they added more than 20 million shares of SLV in the fourth quarter. I mean, when you see a position of that size, does that look like smart money preparing for physical stress, or is it more likely just standard market making and a hedged arbitrage that the retail crowd is misreading as a directional bet?
No, I think it is smart money. I mean, look at who's buying. Yeah. I mean, look at Tether now, the biggest buyer, really, private buyer of gold, and not just physical gold. They're buying up the gold royalty companies. They just bought into gold.com, which used to be A-Mark, which is a retailer, like me, only, they have a bunch of different brands under the same umbrella. But, Tether is now branching off not only into gold tokens, but retailing gold. And so they're at the heart of the crypto market, and even they can see the direction that things are going.
A 20 million share ETF position sounds directional, but structure matters more than size. As Peter Schiff points out here, he interprets Jane Street's SLV addition as smart money accumulation, yet 13F filings often reflect hedged arbitrage, not conviction bets. Institutional flows can amplify narratives without signaling physical shortages. The more interesting shift may be Tether diversifying into gold-linked assets while anchored in crypto liquidity. That suggests hedging systemic risk, not abandoning digital markets outright. Investors should separate marketing optics from balance sheet strategy. Next, Peter Schiff discusses why tokenized gold could change demand dynamics.
So it's moving to gold, and to the extent that we're going to have crypto, it's going to be tokenized gold. That's going to be the main, type of token, not tokenized nothing, which Bitcoin is, fiat token, but a token backed by real money, which is tokenized gold. I mean, I'm doing that myself with T-Gold. I've got, I haven't tokenized anything yet, but I'm building the framework for my customers to use gold as a medium of exchange, not just to hold it as a store of value, but to use it in commerce. That's what gold was meant for. Gold is money, and it's the best money. And now with the technology that we have today, it's even better money than it used to be. It's more fungible. It's more divisible. It's more portable. It does everything that Bitcoin promises to do, but can't.
How exactly does a stablecoin issuer buying gold change price discovery? I mean, you bring up Tether, talk about a physical market. I mean, they're buying bars and top vaults are taking delivery through specific channels. What's the bigger implication here? Does it tighten physical liquidity, or does it just create another layer of paper claim on metal?
Well, I mean, I think it increases demand, obviously, so it'll lead to higher prices, but it does provide liquidity, but it provides more functionality.
The money may be migrating back to hard assets. As Peter Schiff points out here, tokenized gold isn't just a digital wrapper. It potentially redirects speculative liquidity into vaulted bullion, tightening real supply. If stablecoin issuers are accumulating bars rather than derivatives, that changes physical flows, not just price charts. But investors should question transparency, audit trails, and rehypothecation risk before assuming scarcity. Increased demand can lift prices, yet layered claims can also amplify leverage. Next, Peter Schiff discusses why gold-backed tokens could outperform dollar-pegged stablecoins.
And I think that when it comes to stablecoins, all the focus has been on tokenized dollars, right? Stablecoins backed by the US dollar. And I think that given the choice between having a token pegged to the dollar and having one pegged to gold, gold wins hands down. I mean, look at the track record. Look at how much value the dollar has lost relative to gold. You know, when we started the Federal Reserve in 1913, you could buy an ounce of gold with just $20. $20. Now you need $5,200 to buy the same ounce of gold. So gold has a much better track record than fiat currency, than the dollar. So if you're going to have a stable coin that's stable to the dollar or stable to gold, hands down, you're going to take gold. The only thing the dollar has over gold is that you earn interest on it. Except when you own a stable coin, you don't earn the interest. The issuer keeps the interest. It gives you nothing. And so if you're going to hold a non-interest bearing token, one that is stable to the dollar and one that is stable to gold, what are you going to pick?
Yeah.
Right. And if I'm a merchant, if I have services that I'm providing, I have goods that I'm selling, and I want to be paid, would I rather be paid in paper or real money?
A century of currency erosion is hard to dismiss when you run the numbers. As Peter Schiff points out here, gold rising from $20 in 1913 to over $5,000 reflects more than appreciation. It reflects dollar dilution under Federal Reserve policy. Stablecoins pegged to fiat inherit that long-term decay, even if short-term volatility is lower. But investors should also weigh opportunity cost. Gold yields nothing, while Treasury bills in 2024 paid over 5%. The real debate is preservation versus income. Next, Peter Schiff discusses why merchants might eventually prefer gold over dollars.
Would I rather get paid in gold? Of course. The only reason I'm not paid in gold now is because it's not easy. It's complicated. But if it's just as easy for me to get gold as dollars, and I can just as easily use my gold to pay my own bills, then why the hell wouldn't I want gold?
Yeah.
I mean, then I can escape inflation. And then, when you have gold, everything gets cheaper. Over time, the longer you hold your gold, the less gold you need to buy stuff. The opposite of what happens with dollars. If you hold dollars, they lose value. You need more dollars in the future to buy the same basket of goods and services, whereas you need less gold. So, I mean, gold is a far superior. And so now that you can tokenize it, I mean, that's what's going to win. There's no reason to have tokenized dollars, but there are a lot of reasons to have tokenized gold.
And I mean, if gold-pegged stablecoins win, what's the actual adoption path? Is the killer use case cross-border savings? Is it merchant settlement, like you said, or is it capital flight hedging?
It's everything.
Yeah.
It's a way to get out of the fiat system.
Escaping inflation sounds simple. Operational reality rarely is. As Peter Schiff points out here, the appeal of getting paid in gold hinges on frictionless settlement and universal acceptance, neither of which exist at scale today. Yes, gold has preserved purchasing power over decades, especially during inflation spikes like 2021 to 2023, but transactional adoption depends on tax treatment, regulation, and volatility tolerance. Businesses care about cash flow stability more than ideology. For investors, this is about diversification, not abandoning fiat overnight. Next, Peter Schiff discusses how gold tokens could bypass traditional banking entirely.
It's a way to get out of the banking system because you can get all the functionality of a bank without having a bank. Because when you deposit your money with a bank in order to gain access to the liquidity that they provide, ATM, debit cards, checking, stuff like that, you become a creditor of that bank. What if the bank fails? Now, we got deposit insurance, but you're still a creditor. But when you have money in a gold stablecoin, you own the gold. It's your gold. You're not anybody's creditor. The token represents a receipt, really. It's your ownership, proof of ownership of that gold. Now, if you have all the liquidity that a bank provides with your gold via that token, what the hell do you need a bank for? You don't. If I can settle all my transactions, if I can pay all my bills, if I can get paid the money I'm owed, and I never need a bank, and I never need to touch the dollar, then why would I? Right? So this is the direction that we're going. Yeah. The only thing that could stop it would be the governments themselves that try to outlaw it, because they recognize that if you're given a choice between the defective currencies that they produce that are designed to lose value over time and real money, you're going to choose real money every time.
Bank disintermediation is the quiet fear behind this entire conversation. As Peter Schiff points out here, depositors are unsecured creditors, even with FDIC insurance caps at $250,000, a reality many rediscovered during regional bank stress in 2023. Gold-backed tokens promise ownership instead of counterparty exposure, but custody, jurisdiction, and legal enforceability become the new risk vectors. Eliminating banks doesn't eliminate trust, it relocates it. Investors should weigh systemic risk against regulatory backlash, especially heading into election cycles. Next, Peter Schiff discusses whether governments will tolerate this shift away from fiat control.
Yeah. Must scare the hell out of the banks, though, huh? I mean, taking over their returns.
Well, yeah. I mean, people obviously would be pulling the money out of the banking system and buying gold with it. And yeah, that's a problem. It's also a problem for the economy, too, because money that's in gold is not being loaned out to entrepreneurs to make capital investments. Mm-hmm. Although banks are not really doing that with their money anyway right now. That's part of the problem. They're buying mortgages. They're buying government bonds. So they're not really helping to grow the economy the way it is. A lot of that money is being raised through equity deals by companies and by the companies selling bonds directly. A lot of it isn't being financed by banks anymore.
Wall Street keeps calling banks engines of growth, but look where the money actually goes. As Peter Schiff points out here, deposits shifting into gold would pressure banks. Yet he also admits banks are already parking capital in mortgages and government bonds rather than fueling real entrepreneurial expansion. Since 2023's regional bank stress, balance sheets have tilted even more toward treasuries, not small business lending. So the fear narrative cuts both ways. Are banks losing productive capital or just cheap funding for sovereign debt? Next, Peter Schiff discusses how this shift reshapes credit creation itself.
I don't know if you heard about this new major news out of India. The CBEBI has updated their rules, giving India's $385 billion actively managed equity funds a lot more flexibility, allowing up to 35% to go into gold and silver instruments. They're also shifting valuation towards domestic spot pricing starting on the 1st. I mean, if even a fraction of that capital pool rotates into metals, what does that do to the global physical market? And how important is that India is moving valuation away from the London-based price conventions?
Yeah, it's always been a bit suspect that you have a bunch of people in England, in behind closed doors, deciding on what the price of gold should be and fixing it. I think it's a much more transparent process if it's just fluid and you can see the price and you use real markets to set it. But look, it's obvious that demand for gold is rising. It's rising from central banks as an alternative to the dollar. It's rising from private investors as an alternative to a lot of things, including U.S. treasuries and other dollar-denominated debt. And so all of this demand is going to be growing for years and years to come. Prices are going a lot higher. There's just no other way around it. And if you look at the value of gold today relative to the total value of financial assets, stock market, bond market, real estate market, gold is still relatively small compared to, where it's been in the past. So it's got a long way to go.
A $385 billion pool quietly gaining 35% flexibility into metals is not a footnote. It's a structural bid. As Peter Schiff points out here, shifting pricing power away from London conventions toward domestic spot markets hints at a broader rebalancing of who sets the marginal gold price. Even a 10% rotation from that capital base would represent tens of billions chasing a relatively tight physical market. With central banks already net buyers since 2022, valuation gaps versus global financial assets matter. Next, Peter Schiff unravels how this demand wave could overwhelm traditional price discovery mechanisms.
Yeah. So do you think, the East seems like it's more in control of the pricing right now on that metals market. If you look at the New York futures, Shanghai, now we get these tokenized rails too. Is this going to change into regional pricing and premiums, U.S. paper price, Asian physical price?
Well, I don't know, but it's clear that the demand is growing more in the East than in the West. The West has a ways to catch up. In fact, for the past couple of years, as there were Eastern buyers, there were Western sellers. Americans throughout all of 2024 and most of 2025, U.S. retail was a net seller of precious metals. Yeah. They were selling gold ETFs. Money was being taken out, but the price was going up anyway, despite the fact that Americans were selling. Why was that? Well, that's because the Indians and the Chinese, they were buying. They were buying more than we were selling. But now that Americans have stopped selling and now they're buying too, right? That there's only so much gold there. So the prices have got to go a lot higher. And again, a lot of the crypto demand, money that was going into crypto is going to start going into gold.
When price rises despite Western ETF outflows, something bigger is absorbing supply. As Peter Schiff points out here, throughout 2024 and much of 2025, US retail investors were net sellers, yet gold advanced because Eastern buyers, particularly in India and China, overpowered that liquidation. That exposes a flaw in the paper sets price argument. Physical demand can quietly dominate futures narratives. If Americans shift from crypto back into bullion, while Eastern accumulation persists, float tightens fast. Regional premiums could widen before headlines catch up. Next, Peter Schiff discusses what that supply squeeze means for global allocation shifts.
When do you think it's going to start going into miners?
It started. It's already started, but I think it's going to accelerate. Yesterday was a great day for miners. Today's another great day. A lot of these gold stocks are hitting new 52-week highs today. They hit 52-week highs yesterday. Gold is still, off its highs. The gold was above 5,500. It's now below 5,200. So even though gold is off its highs, the stocks are making new highs. And in fact, by the time gold hits 5,500 again, which it will do soon, the gold stocks will be much higher than they were when gold first hit 5,500.
So, leave the viewers a little bit with some actionable takeaways. JP Morgan recently raised its long-term framework and highlighted names like Anglo Gold, Ashanti. For investors watching who are trying to get exposure through the miners right now, I mean, what's your single most important filter? Are you looking at, jurisdiction, balance sheets, the cost curve, capital discipline? Where are you at?
Well, I think right now you've seen a recent move up in some of the larger cap producers that had underperformed for years because rising costs were undermining their profitability.
Miners making 52-week highs while gold sits below its peak is a classic leadership tell. As Peter Schiff points out here, equities are front-running the metal itself, suggesting margin expansion expectations as costs stabilize and bullion revisits 5,500. That divergence matters because miners are leverage plays on cash flow, not just spot prices. After years of cost inflation compressing earnings, even flat gold prices can drive operating torque if discipline improves, but balance sheets and jurisdiction still separate survivors from hype. Next, Peter Schiff shows where that leverage could surprise investors most.
Even though gold prices were rising, costs were rising a lot as well. I think those stocks have moved a lot in the last couple of years, catching up a little bit with some of the companies that didn't have that exposure, like the royalty companies that were just taking their money off the top line and didn't have to worry about the rising costs. But I think right now, the sweet spot is in a lot of these junior mining companies that didn't participate as much as some of the senior or mid-tier producers in the last year or two. I think that's the best bang for your buck. It's a difficult area of the market to kind of navigate on your own because there's a lot of landmines in with those gold mines. You could lose a lot of money in these smaller companies. But I think a lot of these companies are going to get bought out by the bigger companies that really need to expand their reserves. They haven't been investing in exploration and development, and so they need to replace the gold that they're mining.
The real leverage isn't in the giants anymore. It's buried in the overlooked juniors. As Peter Schiff points out here, senior producers and royalty firms have already re-rated after years of cost pressure, while many smaller explorers lag despite improving gold economics. That creates asymmetry. Majors need reserve replacement after underinvesting in exploration since 2020, which historically fuels acquisition cycles. But juniors are operational minefields, financing risk, jurisdictional shocks, dilution. For long-term investors, position sizing and balance sheet scrutiny are everything.